Hi, and welcome to the weekend Q&A marathon, where we talk macro, try to make sense of markets that don't make any sense. But in today's episode, we answer your questions so we can try to become better investors. I'm Steven Van Metre, your host. Thanks for watching. And all we have today, like I said, your questions, so you can read them along with me. Let's just dive right in. First question comes from me, because I forgot to ask it during my last episode. Why aren't large government deficits and massive borrowing programs inflationary? I thought money was created when people borrow, so the government is creating large amounts of money by deficit spending, which must be inflationary. Man, that is a great question, Steve. Glad you asked it. So here's the difference. When you and I borrow, how do we do it? We go to a bank. So let's just think of a micro transaction. You swipe your credit card at the value menu at whatever your favorite fast food joint is, or if you don't like fast food, wherever that is, and you create a micro miniature little loan. Now you might pay the credit card off at the end of the month. That's fine, but that is money creation. So when you borrow money from a bank, money is created. Now when the federal government borrows money through the US Treasury, who do they borrow from? Do they borrow from the banks? No, they don't get a loan from the banks. They go out and borrow money from people who already have dollars. So foreign investors, foreign central banks, US investors, and securities dealers, none of which are banking institutions. Now, if the federal government did borrow from the banks, then it would be creating money, but they're not. They're borrowing from the pool of money. It'd be no different instead of going and swiping the credit card to get that 99-cent soda, you went to the loan shark and he gave you some money out of his personal pocket. That's not money creation. So the federal government does not, or federal deficits, massive borrowing is not inflationary. In fact, it's the opposite, because it pulls money out of the economy, shuffles it through the inefficient government system, and shoots it out the other side. It doesn't actually create inflation at all. Next, if the Fed and or U.S. banking system fail to buy enough U.S. Treasuries, the U.S. dollar will begin to rise as the U.S. government crowds out all other securities issuers. Correct. Now, this question comes from one of our friends whose English is not first language, so that's why we're trying this new format, so I hope you like it. And this is not correct, no. The Fed's purchasing of U.S. Treasury securities doesn't even matter. It's just a bonus to suppress interest rates. It doesn't change the picture at all. And if you think about it, since the federal government, when they borrow, is not creating money, then interest rates actually go down. So if you look at a chart, if you take the total federal government debt and you invert it against, say, 10-year U.S. Treasury yields, you'll see that as the government borrowing goes up, interest rates go down. So no, it has no bearing on if the Fed is buying anything or not. The Fed is buying is a bonus to suppress interest rates. It has nothing to do with the U.S. dollar rising. The U.S. dollar rising has more to do with a shortage of U.S. dollars in the international community. So no, I'll say this isn't correct, but the government does crowd out other securities as they dump and borrow more and more money and pull more dollars out of the system. So the only winner would be the U.S. dollar. I do think the U.S. dollar rises. First, U.S. Treasuries would win. I do think U.S. Treasuries go up. Later, even U.S. Treasuries would get sold aggressively. Now, yeah, I think that when interest rates get down to zero or slightly negative, yeah, there's going to be the smart money is going to be dumping them because they've been holding them. Sending U.S. Treasury yields higher in a market crash. Usually when U.S. Treasury yields go down, markets follow down. So that I wouldn't say yields higher equals market crash, yields lower equals market crash. And likely sending gold down with equities and U.S. Treasuries, correct. I do believe gold goes down and equities go down when yields go down. But when yields go higher, that becomes that is where you start to see inflation show up. Because the Fed will buy whatever they must, good for gold and stocks. I think more of the question is when yields do eventually go up, would that trigger inflation, at least from a economic reading standpoint? Yes, it would. And would that be bullish for gold and stocks? Yes, that most likely would be. So that what we'd be looking for is real yields to go down or inflation-adjusted yields to fall. All right, next question. I'm a believer in the idea that history doesn't repeat itself, but it does rhyme. I'm wondering if we will see any global trade hindrance as a result of rising east-west tensions and uncertainty. Do you see any contemporary comparisons to the Smoot-Hawley tariff? You know, I do, and I did complain about the trade deal with China and us trying to force them to buy U.S. goods. Now, as an American, of course I want China to come and buy our goods and services. From an economic standpoint, we can't force them. So the world dollar liquidity cycle says they need to choose what they want to buy. Now, whether it's buying our debt or buying our farm products or buying goods and services, it doesn't matter. The primary focus needs to be they need to choose. And that choice really needs to be the debt. So yes, I do think the tensions between the largest importer and the largest exporter, big problem. I was not a fan from an economic standpoint of the China-US trade deal, not that it appears to be really in existence beyond paper to begin with. If not, do you think legislative action will eventually sour in response to the economic slowdown? It will. I think I do think it will. I think you'll see protectionism show up again. I do believe that. I'm assuming the 1930 tariff had good intentions. What's stopping us from making a similar mistake on our road to recovery? See, I actually think we are making a similar mistake. And I wrote about this some time ago when the trade deal was surfacing. And why did we have the tariffs in 1930? To put Americans back to work. We were on the gold standard. Today we're on the dollar standard. Back in the 1930s, we had all the gold. Well, we have all the dollars. So the international community back then needed gold just the same that they need dollars today. So as we close down, put tariffs or restrictions or anything to restrict global trade, it doesn't help the recovery. It makes it worse. So I think we are making the same mistake. I saw your videos on QE. If QE is about borrowing treasury bills from the commercial banks to reduce interest rates and the collateral is stored in the Fed member bank, that is correct, then how are the Fed and Treasury buying corporate bonds and high yield ETFs? All right, we'll start with this. The Treasury is not buying them. So let's talk about what's going on. We need some illustration here. Trash can. So the Fed has something called a special purpose vehicle. I refer to it as a trash can. And what the Fed does is they put some money in the trash can. And then they go and find somebody such as BlackRock, who is experienced in buying junk. And they say, hey, BlackRock, we put some money in the trash can. You go put some high yield bonds. What kind of high yield bonds go in trash cans? You're right. The worst of them are going in the trash can because it's trash can. And so their trash can gets filled up with stuff that nobody actually wants. The US Treasury comes along and says, wait a minute, that trash in that trash can might lose value. The Fed, you're not allowed to lose value. So at the same time, the Fed, through BlackRock, see, the Fed is not actually going out and buying this. BlackRock is doing it. The Fed actually must also buy some Treasury securities to act as insurance against potential losses. So they are using what's called a special purpose vehicle, or what I refer to as a trash can. Because remember, what do you put in a trash can? Stuff that nobody wants anymore. That's how they're doing it. You said that monetary easing is deflationary until it's inflationary. That is correct. I believe that was similar to Friedman's 1998 advice for the Bank of Japan in terms of quantitative easing. And if it doesn't work, do more QE. That seems to be the idea today. So my question is, how can that be possible since Japan teaches us it doesn't work? Well, that's a good question because in America, we believe it still works. And as long as we believe something works, it does. Look, around my house, as long as you believe in Santa Claus, he would show up. When you started saying he didn't exist, well, your quantity of presents was dramatically reduced because Santa didn't come anymore. I still believe in Santa Claus because he still shows up. So as long as people believe that QE does all these mythical things that we assign it, then the Fed will continue to do it. And I think that's what happened in 1930 is the Fed did what was QE, what we call QE today, and it didn't really do anything, and people lost faith and they quit. And Ben Bernanke came along and said, modern times, well, they should have done more. Well, I think what he missed is it doesn't do anything, which he probably knows, and people lost faith in it. So wait till this time when people realize that quantitative easing doesn't magically make the economy turn around, it will go down. And we could learn that from Japan, but we're not going to. The only solution I can think of is, let's use Friedman's words, the Bank of Japan can buy government bonds in the open market, paying for them with either currency. I presume what he's referring to, Friedman's referring to, and I don't know because I've not read this quote outside of having it sent to me, is that they have dollar reserves or other currency reserves that they could use to buy the debt with, which would be in fact money printing since it's currency, not reserves. Am I right? But then the Fed cannot do that. So I'm going to say I think you're wrong. And the reason is if a central bank, such as the Bank of Japan, was indeed printing money, they'd have hyperinflation. And the dollar is the world's reserve currency, but in the Asian region, the yen is considered a reserve currency. So no, I don't think they're printing money. I don't know exactly the mechanics of the BOJ. I know it's somewhat similar, but not exactly like the Fed. The Fed, however, you're correct, they cannot do that. They cannot print money. The Fed has the most restrictive conditions of any central bank as my understanding. Can lowering the interest on excess reserves increase the money supply by inducing banks to lend? The Fed's own website makes this claim, saying if the IOER rate is 0 or too low relative to lending rates, bank credit could rapidly expand and the economy could overheat as banks seek to lend out their own reserves to earn a positive return. Can we chart IOER next to bank credit and see if this is true or false? Yes, we can. And here you go. Here's IOER on the left, here's bank credit, and you can see it pretty much. You could argue that something was going on here. There's a relationship here, but the question is, was this move in bank credit specifically due to a reduction in IOER? Nope. I don't think so. It had more to do with the demand by commercial industrial loans is what's causing that. So no, in theory, yes, the Fed is right, but in actuality, I don't think it really does that much. The banks have to be wanting to take the risk, and borrow has to be wanting to take risk too. And banks don't really need to worry about that. They're not even lending one time against their deposits, so they can lend up to 9. I don't see why this makes a difference. But as long as it makes people think it makes a difference, that is what matters. Is deflation good or bad for the average American? Now, this is an interesting question because there's two answers to it. It seems like it would be good since they can afford more stuff and businesses could sell more stuff. All right, so inflation is great for the debtor. Deflation is good for the saver. So is the average American loaded up with savings or debt? Well, the average American is up to their eyeballs in debt. So deflation's bad because when deflation happens, usually your pay goes down. Now, doesn't mean it could mean you lose your job, could mean your hours are cut. It just means your income is going to go down. Now, does your debt go down when your income drops? No. So for someone who's a saver, then deflation is great because maybe you wanted to buy that new car. Well, now it should be cheaper. That new TV should be cheaper. Things that you want, and maybe you want to buy some property or some stocks or invest. All those things get cheaper. So for the saver, which there are very few of, deflation is great. So I'll say for the average American, deflation is bad news just because of the sheer amount of debt. All right, thank you very much for the Memorial Day special video. You're welcome. Believe it or not, I watched the entire video and even rewound to catch some important points again. Apologize for the following long question. No need to apologize. We both agree equities are dislocated from reality. Yes, but my brain likes to be a contrarian. Nothing wrong with that. So I'm curious what you think about the reopening. Theoretically, you said equities should make a good faith recovery when the economic data begins to improve. I would agree with that, but the economic data hasn't really improved. I assume you're talking about indicators like unemployment, manufacturing. Yeah, that would be correct. As displayed by other countries, these economic indicators will improve drastically in the short term as the government reopens the economy. I haven't seen that in other countries. I've seen the opposite, but okay. I personally believe they will lag, degrade again after a short rebound. I would agree with that as well. This is contrary to most recessions where these indicators tend to degrade slowly over time. True. Service industry and travel will hire back people soon, even if at below pre-COVID numbers. I don't think they're going to hire a lot of people back. I mean, now that we're seeing states reopen, the case numbers start to rise. I think the summer travel season is dead on arrival. My point is we will see a rebound in many economic indicators. We will see. The only question is how high. I've seen data from firms say that equity markets materially rebound after max unemployment is hit, and you seem to echo this. But does this cause the markets to rebound without looking back? If not, what is the material catalyst for a pullback in market sentiment changing to a risk-off approach? Yeah, this is interesting because arguably you could say we went from zero to peak employment in a blink of an eye. And you're correct. Normally recessions, it's just, it builds. So the question is, even if we've hit the peak, is the worst behind us? I don't think so. I mean, as I said in the Friday video, if we're still seeing between 5 to 10 plus million unemployment, yeah, that's bad. I mean, that's a recession. So will there be a rebound in economic data? To some degree, there has to be. When a business is closed, reopens, sure, you have to have some sort of increase. The problem what we have is the Fed is creating deflation. So any increase in the economic data will soon be offset by the deflationary forces of the Fed. So yeah, I think there could be a rebound in the economy, but I also will agree with you it's going to be short-lived. Now, what did the stock market do? The stock market acted as if this was a blip on the radar and people bought the dip. There's another question about that, so I'll save my opinion on that. So let me just make sure I answered your question. Let's see. Does this cause the markets to rebound without looking back? Arguably, you could say that now, but I think the stocks are going to get caught up in this deflationary wave because we've seen that Treasury yields are not validating the move in stocks. Treasury yields are telling us financial conditions are tight and the economy is not recovering and there's no inflation, at least not increasing inflation. And the data is saying, yeah, there is deflation, and on a year-over-year basis, there's disinflation headed to deflation. So yeah, I think stock prices are in for a rude awakening. Thanks for the great videos. Thanks for the work you do. You're welcome. Question, I am a foreign central bank. Why would I not buy the whole day Apple and Facebook shares with my freshly printed money? Say Swiss National Bank buys US shares in euros to keep the Swiss franc down, helping export. Isn't that better than buying worthless treasury bonds that will only be inflated away later on? Balance sheet goes to the roof. Number one in the world per capita, but who cares? Would you? Is this clever or only clever until? Well, here's the question. So I kind of mapped it out. So they're selling francs to get US dollars, which devalues the franc versus dollar to increase exports. They're buying US equities, hoping they will rise. If equities rise, if I got this right, they don't have to sell more francs. But what if US equities fall in a deflationary period? Would they not have to print more franc, lead to high deflation? So let's come back. Is that better than buying worthless treasury bonds? No, because in a deflationary period, those treasury bonds go up in value and then you would sell them. That will only be inflated later on? Well, at the moment, the Fed has no mechanism to create inflation, so that doesn't appear to be the case. I mean, you'd have to see a law change. I think this is clever until it's not. I think the Swiss National, or what is it, Swiss National Bank is trying something and it appears to be working. But again, what happens when deflation hits and U.S. equity prices do fall? Swiss National Bank's got a major problem. They might have to end up buying U.S. Treasuries to hedge their loss. We'll see. Question 2, if the Fed doesn't buy enough Treasuries, everything will go down, including long-term bond Treasury bond prices. No, not at all. That has no. Think of the Fed as a bonus in terms of suppressing interest rates, but no. If they stop monetizing, interest rates will still go down. The only exception, U.S. dollar. The U.S. dollar could be the exception here. If the Fed doesn't monetize enough, the dollar could weaken. By creating deflation, the dollar goes up. So if the Fed doesn't buy enough treasuries, then I would say the dollar weakens. I think But no, the interest rates don't go higher and bond prices don't go lower because the Fed isn't buying up the debt. Thanks for the example about how the Fed lends its reserves to banks. Going back to your camera example where the Fed gets a camera, treasuries, from a bank and the bank gets extra money in the Federal Reserve accounts as collateral. Is there any chance the bank could spend this money and lose it somehow and not be able to pay it back? No, they can't touch it. It's in their name of, but they cannot get it. Does the Fed have the power to demand their collateral back at any time? Conversely, can the bank say, okay, I want my camera back? Nope, they can't. Fed is the big boss. The Fed can. I mean, the Fed can say, hey, here's your treasuries back. That's called quantitative tightening and take our cash back. But no, the banks can't force the hand. From this last video, I'd love to hear what your decision. Oh, your dad made the change the direction of your family. There was a second question that came in. Excellent as shows always. Thank you. I'm interested to know what your dad learned and what decision he made that made such a change. Was it bonds? The bonds did play a component in it. So here's what Dad and my mom did. So when they lived in Los Angeles at the time. So before they knew each other, when my mom went to work, she lived at home with her parents. And she saved all her money. She did buy a VW Bug, but beyond that, her parents were very focused on saving. So she saved her money. After my parents got married, they got an apartment, and my mom wanted to quit her job. And of course, they didn't have kids at that time. And so my dad said, that doesn't really make a lot of sense. And she goes, well, how about this? As long as I work, we save 100% of my check. And my dad said, fine, no problem. I'm good with that. So at some point, they decide to start a family, and they're going to need a house. So they end up buying a house outside of their normal economic means. So if you looked at how much, because at this point my mom was going to quit her job. So if you look at what my dad made and what his peers made and what type of houses they were looking at buying, he was buying a house that was much nicer and more expensive than his peers. And the reason they could do it is because they had the down payment from my mom. So they bought this house, and my dad will tell you that he remembers, he'll tell you to the day, he knows exactly the payment to the penny, and he's probably going selling that right now as he's watching the video. And he didn't even know at the time how he was going to make the payment, but he got the loan. So fortunately, he was able to work, second shift, night shift, any type of extra work he could get his hands on, he took advantage of it because he needed to. And now they would have bought the house, and I don't know the date, but it would have to be in the very late 60s or very, very early, like 1970 or 71. It had to be right around that window. Now, at some point, shortly thereafter, the Los Angeles housing market goes up. And now they're sitting on a massive amount of equity. I mean, by all intents and purposes, they're pretty rich. They got all this equity. But if you own a house and have equity, you can't really do anything with it. So a financial advisor, I'll skip the story of how that part came to be, says if you had equity in your home, what you should do is take the equity out, refinance your house, and buy bonds. I'll get to what the actual result was. Now, my mom didn't really want to move because her parents lived in Los Angeles, and they were living in Glendale, and so my dad gets transferred up to Bakersfield. Now, he had done work for IBM, who he worked for up in Bakersfield, and he was just amazed that instead of spending an hour to drive home, that you could drive home in 5 minutes. So he thought that was pretty great. He also did not like the idea of raising his children in the LA area if he didn't have to. So he gets transferred up there, so my mom has now no choice. She's going to go along with this. And so he builds a custom home in one of the nicest neighborhoods in town. Now you might think, well, he would pay cash for this house, and he didn't. Now it wasn't opulent by standard of what custom homes are today. It's a very nice neighborhood. It was a nice big home to raise a family, and great, probably the best public school district in town, and literally 5 minutes away from his office. So this was perfect. So what he did is he went out and got the biggest mortgage he could get, which at that time was a 14% on a variable rate loan. Now, if you're asking, well, why didn't he get a fixed rate loan, which I have asked him myself, he will tell you, well, they didn't have fixed rate loans back in the early 80s at all. So actually that means they must have bought the house sometime in the mid 60s, because we moved to Bakersfield in 81. So or maybe they bought in early 70s. But anyways, so he gets this big mortgage. Now, obviously, he's got to make the mortgage payment. But when you think about this from a tax perspective, when you have a big mortgage, a stay-at-home wife, and 2 kids, which he then did at that time, what do you think he paid in taxes? 0. He didn't pay any. Now, but he's got a problem. He's got to make this mortgage payment. So you're thinking, well, why didn't he just pay cash for it? Because the other advice he got from this financial advisor was, go out and buy tax-free California munis. Your income's tax-free. At the time, they were paying 12% a year. So my dad effectively was able to use the interest off of the Cal munis with his principal intact to pay his mortgage. And as interest rates went down, every 2 years he would refi. I remember as a kid, it seemed like we were always going to see the mortgage people. Now as a kid, it always is not every year, but as interest rates went down, I remember we'd go to see this person about refinancing. My dad was a refi king. I mean, every 2%, bam, bam, bam. So we got to, as kids and a family, we got to live in a nice neighborhood that we normally probably wouldn't have. Now, did we have, the foreign cars and the foreign vacations and all the, no, we didn't. But we had a good education and we had a safe neighborhood and a good upbringing. And had he not done that, odds are you probably would have worked till 70, you probably would have lived in LA, who knows. But that one advice, that macro advice, completely changed the course of our family. And he called me the other day after he saw the Wednesday video, and we were just kind of going back like, wow, how that changed everything. And because of that event, we learned as a family to start making better financial decisions, which have flowed down the hills. As I mentioned, I think Monday or Wednesday, to say that 20 years before retirement, I've got my target number hit. Macro changes things for you, changes your family. So you might think my situation can't get any better. Well, maybe it can't, but maybe there's things you can do to make your kids' lives better. What can you do to change future generations? Teach them these things. So that's the story. Next, I'm a subscriber of your YouTube channel. Really good stuff. Hey, thanks. I was really impressed with your video around QE not being inflationary. I love your data-driven approach to things. Many folks on Twitter and the internet barely have any data to back up their views. I know. Drives me crazy. Thank you. I appreciate the comment. I'd like to ask if you can do a video around the current post-March 23 low bull market, and more specifically, if you like fundamentals, technicals really matter at the moment or not. So I'd like to know if things like price discovery matter, and if they do, how does an investor decide when the price is right? I'm not sure exactly what you wanted me to do, but I will answer the question. Is the March lows were not based on any fundamental or price discovery. It was literally a buy the dip, the Fed is easing. So investors, not only did they buy the dip because they've been conditioned to buy the dip for the last 10 years, they bought because the Fed told them and it was doing all this easing, and they're convinced that is what magically makes stock prices go up there. They're so short-sighted, they can't see that their own buying makes stock prices go up. And then beyond that is you saw investors trying to beat what they thought is a blip in the economic data. Literally people are like, everyone's going to go right back to work. They've got all this extra money now from the government. I'm going to get in early. And the reality is it's not going to play out that way, because the Fed, as I said in the previous question, is deflating the economy. And the data so far is not showing any V-shaped recovery at all. You're seeing a couple little things popping up here and there, but the majority of the data is not substantiating this. And if indeed the case numbers resume, because remember there was some hope about the virus that the heat would kill it. Well, we knew it wasn't. If you go back and look in the Asian countries where it got hit, hot and humid, you look at Brazil, hot is not slowing this thing down. But there was some hope that maybe it would, and you got to have hope. But yeah, that bottom was not based on anything but just sheer speculation, nothing else. That was it. Your channel is one of the most underrated on YouTube, in my opinion. Wow, that's awesome. Thank you. I watch Real Vision and a few other channels. Never really helped me as much as your channel, which is a wealth of information. I really appreciate that. That's a very nice comment. I am a subscriber to Real Vision. I've been a subscriber from the early days. And I personally think it was much better back in the very beginning. They had a good crew of content providers, and they did things differently than they do now. I truthfully don't watch hardly any of their videos. In fact, some of you sent me a link to, hey, have you watched this video? And I actually didn't, because I didn't think it was that interesting, but it turned out the video by Dr. Richard Werner and the podcast that he did at the same time with someone else, I thought was very interesting. So yeah, I appreciate that. I appreciate that a lot. I read a real vision, said go back to your original model, but ever since they kind of went public, I haven't been a big fan. But I mean, hey, they'll evolve, and maybe everyone else likes it more than I do, and that's okay. So this question came in. It says, do you hold a neo-Fisherian view on macro? Now I wrote back, said I really don't know what that is, and I was kind of busy at the time and I didn't have a chance to look it up. And so they wrote back saying, my meager understanding of neo-Fisher school is that they hold that lower rates of interest lead to deflation. If you want to create inflation, you raise short-term rates. I was wondering if you held some of their views because of your thesis, quantitative easing is deflationary. Thanks for all the great videos. Look forward to the new ones coming out. Hey, dude, thank you. So I didn't really know. Now, neo-Fisherian is, I believe, referring to Irving Fisher. Now, I don't know all of the views of it, but if one of their views, and I know it is lower interest rates lead to deflation, then yeah, I guess I would say that my thesis follows that. Like I said, I haven't time to go dig into all of what neo-Fisherian view is, but at least from that point, yes, I guess you could say that I would hold. Well, the question was, do you hold views? So that is a view, so the answer would be yes. All right, well, that concludes our video for today. Hey, it came out to about 30 minutes, which is right kind of what I was hoping for. I think this format works. I like it. I hope you do too. This doesn't mean I won't have questions during other videos. I just kind of wanted to test this out this weekend and get a feel for how it went. So I appreciate you taking the time to watch. And keep sending your questions in, and I will keep answering them. Again, I'm Steven Van Metre. I will see you next week. The content of this video is provided as educational information only and is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy, sell, or security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in the video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.